Welcome to Finance for You. This is Section A in the Intro to Indicators series, which explains the different types of charts and how to use them in order to make good investing decisions. Let's get started. First, we'll talk about accumulation distribution charts. These use volume and price to assess whether a stock is being bought or sold. Overall, these charts help show how strong a particular trend is. What you want to look for is if the security is in a downtrend, but the accumulation distribution chart is in an uptrend, then this could flag the possibility of the security's trend changing directions. This is caused by high buying pressure. It works the other way around as well. If a security is in an uptrend, but the AD is in a downturn, then the change in direction is possible. This shows high selling pressure. The chart is not usually used on its own, but is paired with price action analysis or fundamental analysis, which will be discussed in future videos. Next is the Advanced Decline Ratio, or ADR. This indicator compares the number of stocks that closed higher against the number of stocks that closed lower than their previous day's closing prices. It can be used to reveal whether a stock is overbought or oversold. If the ADR chart is steep and high, it is overbought. If it's steep and low, it is oversold. A steady increase generally results in bullish trends, whereas a steady decrease mostly will result in bearish trends. This chart is not usually used primarily, but can be used as a complement to mostly all types of indicators. Now onto the Arnault-Legault Moving Average, or ALMA. This indicator eliminates minor price fluctuations and enhances the trend of the market, or basically makes a simple chart that represents the general movement of the main trend line. As you can see in the example below, the ALMA line, which is the smoother line over the trend line, shows the general idea without the added noise of retracements, which will be discussed later. Next up is the Aroon indicator. This is used to identify trend changes in the price of an asset and the strength of that trend. It consists of two lines, one showing the time between highs and the other showing the time between lows. The closer to 100, the more recent the last high or low was, depending on the line you're looking at. When interpreting the chart, it is important to notice the intersections between the two lines. When the arrow up crosses above the arrow down, a bullish price behavior is indicated and can be a signal to buy. When the arrow down crosses above the arrow up, a bearish price behavior is indicated and can be a signal to short a stock. Here's an example. The highlighted area shows the arrow up crossing above the arrow down. As you can see, the trend increases, so it would be a good idea to buy when the oscillator crossed. Now I'll highlight a second area. In this area, the arrow down is crossing above the arrow up, and the following is a downtrend. So a trader would move to short when the lines crossed. However, it's important to remember that these charts are tools to help predict and interpret movements on the trend line. They are not 100% accurate, though, and each decision should be made with plenty of thought and close examination. Now we're on to the Auto Fib extension. This indicator calculates target price levels following a retracement, as well as highlights potential trend reversal areas. A retracement is a temporary change in direction in a stock's trend line, which are highlighted in the chart to the right. This indicator is important because if you know where the retracements are and hold through the temporary low or high, depending on whether you've bought or shorted the stock, the more profit is available. The auto pitchfork is a way for traders to determine characteristics within a stock's trend line and interpret how that trend will act in addition to providing a good stop-loss order. To better understand how the auto pitchfork works and how to interpret it, I'll show you an example. First, you're going to draw 3 points. We're going to put the first one here, second one here, and the third one here. These points are going to be at the end of previous trends. This graph is a little tricky because these trends aren't very big and they don't last a long time, so it's a little hard to see, but this is what we're working with. Next, you're going to draw 3 lines. The center line, the top line is going to be a little parallel to the center line, and the third line is going to run on the bottom of this trend line we're analyzing. So in our graph that we're looking at right now, you see that this rescission happens when it hits the top of the center line. That's what you're looking for in the auto pitchfork indicators. It shows you what the kind of cap is and when you're going to start expecting a rescission. This is important for traders because they know once this trend starts happening at the low point, when they should sell, which they usually sell when it hits the center line, because they know it's going to start a rescission and it doesn't normally pass it. It also is a good graph to help figure out what your short order is going to be. And that's usually going to be this bottom line. That's because it usually doesn't cross the bottom line, but if it does, that means the trend is going to start going in the opposite direction. And it wasn't a rescission, it was a change of trends. So that's how investors kind of indicate their stop order, and it helps them know when to buy or sell. Of course, graphs aren't what you should go by directly or exclusively, but it'll help you get a general idea of how the trend is going and whether you should buy or sell or short or hold. It's important to learn how to make, especially this auto pitchfork graph, because a lot of the times the software doesn't give you an auto-made pitchfork. So it's important to learn how to do it yourself and kind of visualize and understand how these graphs trends are going. The average daily range is a tool that measures the volatility in an asset. It calculates the average difference between the highest and lowest price during a specific interval of time. Overall, it's used over the short term to signal a change in price. An example of how to interpret volatility is shown below. If an asset changes by a greater percent, like asset X in our example, then it is more volatile. The average directional index is mainly used to determine how strong a trend is. It is shown in 2 separate lines, the negative directional indicator, negative DI, and the positive directional indicator, positive DI. The negative DI measures the presence of a stock's downtrend. If it is sloping downward, then it indicates that the strength of the downtrend is getting stronger. It looks like a reflection of the initial chart. The positive DI measures the presence of a stock's uptrend. If it is sloping upward, then it indicates the strength of the uptrend is growing. It looks like an almost exact copy of the initial chart. If the average directional index is greater than 25, then it indicates a strong trend. If it's less than 20, then it's a weak trend. Some important notes to know include it is a signal to buy if the positive DI crosses above the negative DI, and it's a signal to short if the negative DI crosses above the positive DI. Our last indicator for Section A is the average true range. This chart uses the whole range of an asset's price during a period to measure its volatility. It is a form of a moving average and is a useful tool for short-term traders. If it shows high volatility, it represents high risk, since the stock's price is measured to violently swing. A warning to remember while using this indicator is that the volatility of a stock does not indicate whether the stock's price will go up or down. It just provides insight on the level of swing, whether it's steep or gradual. This is a very valuable graph, but is best used alongside others in order for traders to make the best, most informed decisions. Thank you for watching Section A of our series on indicators. I hope you enjoyed, and we'll see you in the next video.